Welcome back to another episode of Bought the Biz. Today we dive into some of these uncomfortable topics. Getting your customers to pay, late payments, what do you do? Getting a collections agency, managing sort of the imbalance of expenses and revenue. What is the impact as a small business owner? How do you pay yourself? When do you do that? When do you not? What is the difference emotionally between maybe the W-2 world and stepping into the leadership role of a small business like this? And then also a little bit of thoughts about working capital, days sales outstanding, maybe some things for searchers to look for, like what I found with a negative days sales outstanding type of business. So a couple of really good gems for you in there. You're not going to want to miss it. Bought the Biz is a podcast for ETA entrepreneurs who've gone from searching for a business to actually running one. It tells the real story of what happens after the deal closes. The day-to-day, operational, emotional, strategic, and leadership challenges that just don't show up in the highlight reels.
The show is story-driven and practical, sharing real experiences from operators along with clear, actionable takeaways you can use in your own business today.
I'm Garth Fasano.
I'm Christi Loucks. Welcome to Bought the Biz. Welcome to this week's episode of Bought the Biz. Today, Garth and I are talking money. We're talking working capital, late payments, inconsistent revenue. This is a topic that it gives me anxiety just bringing it up. So Garth's going to kick it off and take it away because he's got quite an experience with this.
I think that this is a really important topic for any small business owner to hear, any searcher to understand. You know, if you are leaving the W-2 world where you knew what your paycheck was going to be every month, you knew what your 401k contribution would be, you knew all these things, that is all going to change in this world. And the business that I acquired actually had, because of the revenue share model, the revenue was incredibly unpredictable. You know, going into the next month, I knew that our payroll nut was 150, 200 grand for that month, but I had no line of sight into what the revenue would be. And that was sort of always a little bit scary. I knew there would be revenue. I knew it would be good, but I didn't have the exact number just because of the revenue share component of our contracts. And for a lot of people, that could be really terrifying. I think it's also, is what enabled our business to do well. So I think that was a really key part of the reason why I got involved in this business. But, I just have to say that that's not really for the faint of heart. And, while this might be like shocking to some people, looking at the invoices as they would go out every 2 weeks, it was sort of like cheering it on, like, yes, we're going to make payroll. This is good. I think that is sort of a level of uncertainty that a lot of people, are not really prepared for, but need to think through. Now, that was a pretty unique business, and that probably isn't a good fit for everyone. It was something that I was comfortable with, and it worked out incredibly well. But I think, understanding that your personal income is going to vary a whole bunch is really, really sort of important. Like, yes, I still took a salary, so I knew that there was some amount coming in every month, but it was I think it was less than 1/5 my salary at my prior job.
Interesting. That feels hard. And then and then did you have line of sight to that ending? Like, how did you, meaning, yeah,
it
go
is,
ahead.
So I'm now 3 years into this, over 3 years. It is ending on December 31st, 2025. Now, to be clear, like, I actually developed a way to get a little bit more of a look ahead into what that revenue would look like, more so than what the other prior owner had ever done. But, it still wasn't really going to be, it wasn't far enough ahead where we could actually like take significant corrective action, I think. So,
yeah.
But that being said, the business performed really well, and it was set up structurally in a way where we never got lopsided. So it was totally fine.
Mm-hmm. That is one thing that so when we acquired our business, we basically inherited our bookkeeper. And he had a really just like structured and clear way of mapping out cash flow, mapping out like revenue in terms of cohorts. Now we were like our revenue was pretty like cut and dry, right? Like we could see the contracts. There was no real confusion around that. But even just looking out, especially as we had debt payments now in the mix, which were not there prior to our ownership, it was so important for us to be able to see out far enough to know like, okay, what's our runway? What's our cash flow look like? What do we need to make adjustments in the next, 3 months or something like that? So and even to this day, I still work with him and he's fantastic. And we have the same approach. Like we do this like 13-week cash flow exercise every single week to look out far enough to say, okay, based on all of our contracted revenue, like, do we have good line of sight into what's coming? And are there any decisions that need to be made? And I am so grateful that I stepped into that because it was just there for me, like immediately.
I think that process and that sort of 13-week cash flow view is something every small business owner and searcher really needs to have. When I say every small business owner, I'm going to say every small business owner out of ETA with debt financing and a
Yes.
PG. I think some other ones, maybe some other circumstances where folks don't need that. I never did that in my business.
Interesting.
And part of the
Scary.
reason why.
Okay.
Part of the reason why is because when I acquired it, we had negative days sales outstanding.
Ouch.
No, in the good way. We got paid literally before we even invoiced our customers. Yes. You can scratch your head on that.
What? How?
Exactly.
They just threw money at you?
I don't even know if I can describe, like, in a short enough period of time how wacky this process was. It was, were some weird things that, we just did an episode about sort of some of the crazy things you find in your business. This was one of those crazy things as well. But because we were selling on behalf of our customers, we would actually take a deposit for what we sold. And the way it was structured was that deposit would come directly into our bank account the next day. We would not invoice our customers for that sale until they delivered the service and accrued that revenue. And so we actually would get paid.
It's like a commission.
It was basically a commission, but we got paid on it basically 2 to 8 weeks prior to us invoicing for that.
That's awesome.
So every day, literally cash was coming into the business. And so there was never a cash concern. And, in the diligence process on negotiating working capital, the seller told me a statement that I was like, I don't know if I want to dig into this one. And I sort of took it at face value, which no searcher should ever do, which said, you don't need any working capital because you just get paid this money. And I didn't understand what she was saying. I was like, I don't want to fight this one. I don't believe it. I'm going to plan for the worst case scenario here. And I did. And that never was an issue, actually. So I think I might be the only person that was like, felt like that there was a landmine around working capital and there actually wasn't. I think most people don't realize there's a working capital landmine and stumble into one sort of the opposite way. But this worked out pretty well. I think it was also because in the asset purchase agreement, I don't think the seller actually fully understood like work in progress and like where balances stood. It was sort of done like it sort of ended up working just mostly on a cash basis. And I think that sort of did mean I did not need working capital.
I remember during, and obviously we're talking like post-acquisition mostly, but like I do remember in the diligence process, that working capital conversation was lengthy. It was educational to the seller, not in like a demeaning way, but just my husband is like Mr. Finance. So he took on this whole part of the diligence process. But I remember it was just a lot of like explaining how it worked. And now being where we are, I'm so like glad that we took that time to like really make sure that everything around working capital was set for when we stepped into the business.
And
So important.
just to be clear, like I stepped into business. I did not think that that working capital calculation was going to work out in my favor.
Yeah.
And so I drew down on a line of credit and infused cash into the business and just said, I don't need to worry about this. And so that was also why I didn't do these 13-week cash plans, because I was just like, I've got a backup plan. It's covered.
Yeah.
We're good.
Yeah.
And I knew that the amount was far exceeding what I might need, and that I infused in the business in terms of working capital, and I ended up not needing it.
Yeah. Yeah. Well, that's great.
Yeah. But I don't think that's normal.
Positive. No,
I think
probably
working
not.
capital is something a lot more people get tripped up on, and is, neither of us had particularly asset heavy businesses that we acquired. Right. And like, that's where it's much, much more important.
Mm-hmm. Mm-hmm. Yeah, absolutely. Yeah. So let's talk about the whole payment thing.
Oh,
I mean, it sounds like you got like had a crazy payment situation with your customers, but did you have any hiccups, we'll call them?
So I could take this two ways. One, this is like your business making payments, and a common tactic is to defer payments as long as possible. And the other one is like getting paid in money. And so the business's accounts receivable was always less than 1% of revenue. It was in fact, for the majority of the time I ran the business, it was $0.
Amazing.
It is laughable. Like, how is that even possible? I don't really know. Yeah.
So wait, so like walk me through though, like, okay, so what did you do? Where is it now? Like, give us the journey.
Okay. It's a great question. It was because of that sort of pretty crazy deposit process, which actually caused a ton of work on billing and invoicing and accounting. But, essentially we would always get paid, which was fantastic.
Nothing to collect.
I changed that process. And you might be like, what? Are you kidding? That is a miracle. Like, how did you even have that to begin with? I think there were a couple structural issues with the way that was set up. And so as payment facilitator SaaS platforms emerged, we adopted one of those so we could take payments and manage essentially hundreds of merchant accounts as an administrator and take payments on their behalf and send those directly to our clients. And so over time, we did get out of that, we get paid 2 to 8 weeks in advance, essentially, and sort of got into a little bit more of a more normal billing cycle. But I'll be honest, I had customers that I set up this, more secure, more robust system of this, and I had some that would not sign up for it. They're like, I don't put my social security number in anything on the internet. I'm not signing up for that.
Yeah.
Because it was a merchant processor account to get it, like if you sign up for Stripe, it was basically the same process, and they just wouldn't do it.
I know. This is like, well, okay, so we don't have $0 in accounts receivable. We have more dollars than that. Being an agency, that's just the nature of it. And we historically have done a lot of ACH, but now, just because it is such a pain to track down payments, and like, I hate being the person that hounds my clients, because eventually it's going to come down to me being like, hey, this invoice is 45 days outstanding. And so we are looking to go, like, we're going to make a move towards probably Stripe in 2026. But yeah, people are so averse to it. And I'm like, I'm going to eat the fees. Like, you don't even have to pay the fees. I'm going to take that off your plate.
We're switching to Stripe now too.
Yeah.
We were ACH, and that's a mess.
Yeah. ACH is the worst. I hate it. So if you can get off of that as fast as possible. But I do think that there are other challenges with getting people to input a credit card.
Yep.
They don't want to do it because they think you're going to charge them whenever you want.
Yeah. I think Stripe doesn't quite work that way, but
but that's perception.
I know.
It's right. Like it's less about the actual legalities and functionality, more about like, oh, if I'm going to put my card in, they have access to my money.
You can do that with ACH too, just so people know.
Like it's true.
Okay, one thing that we touched on a little bit, but didn't hit on
Yeah.
this enough, I think, and it's a really important one, is also the sort of ups and downs of your personal income every month. Like,
Mm.
how did you feel about that? Or maybe this is just me because of sort of the bizarre nature of, the contractual structure of the business I acquired. But I think but your husband owns a seasonal business. And so, you guys must feel this in some way or another across your portfolio. So give us some thoughts on that.
Yeah, I mean, I feel like my income I have taken my salary up, I have taken my salary down. I have not paid myself commission. I have paid myself commission. I have used my income as the lever to do what's necessary for the business.
But let's also to be clear on this too, like so W-2 folks can hear this. Like you generally pay yourself a salary, and then as the
Yeah.
owner, if you don't have investors, depending on the structure, then you would take payments as disbursements.
Mm-hmm.
And there is a reason to do those in sort of irregular ways so that they don't appear as income
Taxes.
if
Yeah.
that's the way you're doing it. But also a lot of these small businesses, you can't make them regular because things are up and down anyway.
Yeah. Yeah. And truthfully, like we haven't even, so when we acquired, we had so much, our debt was so stupid with that 19% interest rate that like, and yeah, we couldn't refinance it. Again, long saga. Go back and listen to one of the earlier episodes if you want the full story. So like there were no disbursements. Like it was just salary, and it was just a matter of toggling that up. And subsequently, I think I took it a little bit back down towards the end of the year, slowly or incrementally, where I felt we had the cash wiggle room. Now, let's be clear. I was not paying myself much. This was still like hovering around 100K. So we're not talking like, oh, I bumped myself up to 250,
Right.
annual. Like these are meager dollars at the end of the day. So that's what we were doing with that business. So now with we kind of like transformed that whole entity into what we're doing today. And now we've got a little bit different structure. I am almost done paying back my working capital to our investors that pitched in to kind of help us get going at the beginning of this year. And then once we're kind of at that point, then we've got no debt and only pro rata disbursements to make. So
Amazing.
find me in 6 months, let's say, when we're there.
So I think the point is this is like almost never ending in your first bunch of years. Yeah.
Never.
And that's what people need to expect. Like, oh, we take a working capital loan for this that we're doing, so that's going to affect it here. And some months it's going to feel like you're making hay, and others are going to feel pretty scary and tight. Yeah. And that is just some of the nature of it, especially at the smaller side in the market.
Which is where, for sure, where we are right now with these kind of newer endeavors. But I think too, like even like as a business owner, and I think most are, but like I didn't really, I don't know, when you look at the numbers in a spreadsheet, you're like, oh, EBITDA, SDE, wow, like I'm going to get this money. Like that's sort of like, maybe it was just me, but it just seemed a little bit more black and white than what reality actually is. Like when you're in it, I have there's a situation where a client of ours recently hit their own financial challenges, small business. So like I have a lot of empathy for what he's dealing with. It was a whole tax situation. He's been unable to pay the 2 invoices that he does owe right now. Well, I paid myself commission on that contract that he can no longer pay. Now he's been awesome and like very, given the situation, he's not just ghosting me. He's like, yeah, we're going to, fix this over time. But now if you look at that, right, you're like, well, I paid myself all this money and now I'm not going to get that money because he's got his own financial stress. So then the next deal that I closed, from a sales perspective, I was like, don't pay me commission on this one, right? Because now I'm trying to make up for it's just those kind of things that you have to toggle randomly and all without notice, to keep things, I don't know, moving along the way you want them to. Now, I probably could have paid myself that commission, right? But it's just because
It's even wild. You're the owner and you're talking
I'm
about
the
paying
owner.
yourself commission. It's but like
Right.
that's I think part of it is too, like I always wanted to be fair with my team. So
Mm-hmm.
like literally I kept a track of, what were, you know, I take a flight that I could have done it cheaper. What's the difference
Yeah.
on that? And like I would back that out of like my team's bonus structures and things like that.
Mm-hmm.
Like that was just sort of for my own personal honesty.
Yeah.
And I mean, it sounds like you sort of have sort of a similar approach to this in some ways also. So
Yeah.
I think, yeah, the moral of the story is there's going to be a lot of ups and downs. There's a lot of social media and, momentum behind search, and ETA is this fast track way to making money. But I think it really is much more of a 10-year journey to
Yeah.
that sort of those bigger outcomes.
Yeah. Have you ever had to employ a collections agency?
No, but we are now, as the business has continued to shift, as we sort of expanded quickly and got new customers, they were not the same customer profile that we had
Yeah.
before. And so we will be sending out collection notices.
Yeah.
Yes.
How does that
So the
feel?
world is changing. We are still, I mean, collection, they're the right thing to do. You should not feel
Right.
guilty about sending these things. Like that's part of the way I feel. We delivered a service and you haven't paid. Like that's pretty
Yeah.
simple. It's unfortunate, but it's also, I think, something you just have to get used to. Like, this is the part of running a business. This is the expectation. There is a standard number of what your AR is. And, as long as it's within the bounds, which we're still below the targets for our business type and size, that's how it operates.
Yeah. This was maybe a year and a half ago now. We had a client I have never seen anything like it. Ghost hard, like just drop off the radar mid engagement. And I mean, we went from having like regular check-in calls and like touch points to just completely unavailable. And I mean, I sent them probably 50 emails, LinkedIn, like messages, just persistent and direct, not like mean, but like, hey, your invoice is now 90 days late. And we
hopefully you had late fees in there.
Oh yeah, but honestly, Garth, we never got the money. We had a collections agency. They couldn't get a hold of them. I mean, we did everything we could, and we had to write it as bad debt. It was so painful and so maddening. It was probably like 5 months of chasing.
Yeah, we're done with that. We are now fully moving to platform. You pay monthly in advance, and we're done with that.
Yeah. But I think that's like, coming into the business, right? As the owner, like you have to look at all that and decide, is this structure, the contractual structure, the payment structure, is it one, best for the business, and two, like, is it what I want to deal with? Because like I was talking to the collections agency, I was handling that as the business owner, and I don't want to do that.
I know customers that, hey, our CFO told me that they reached out to you over 30 times and he has now started paying. It worked though. Like, so sometimes that is actually what you have to do.
Yeah, you have to be persistent. But I think it is like, to your point, like you have to also stand your ground on like, no, we gave you a service. You contractually signed for that service.
Yeah.
This is fair.
We did have once in the contracts, there were sort of two forms of late fees. And so I do remember during my period where I had very low AR, one time where I had one client who started to get AR up. I gave him a bunch of notices and I just said, hey, like we've been charging you sort of the nice version of the late fees. We're not going to do that anymore. And I moved him up to the highest one that was allowed by law and by the contract. And it was pretty rough. Yeah. But eventually he paid it. Yeah.
Oh, the
So,
joys.
yeah, welcome to the world of small business ownership. Hopefully this gives some people some thoughts on the stability differences between the W-2 world and small business ownership. Definitely put a lot of thought into working capital. If you somehow find a business where you get paid before you invoice, that could be magical. I'm just going to say. I don't think there are many of them out there, but if you can find them,
Unicorns.
let me know, actually.
Look, I want another one.
And yeah, payments both. We didn't really talk as much about paying vendors, but I think what you're going to see a lot more is, what is the AR percentage? Find out if that's in the right sort of guidelines that you can find. And then also, what is the process for collecting? Because at some point you're going to have those tough conversations and you need to be prepared for that. It's going to come to you as the owner. So yeah, we'll wrap this one up and yeah.
Awesome.
Thanks, Christy.